Hi everyone. There are two times in the last 60 years when the US stock market went to sleep for a full decade. Investors kept putting money in, they kept waiting, they kept hoping. At the end of 10 years, they had less than when they started. Not because they made bad decisions, not because they panicked, just because they were in the wrong place at the wrong time. And right now, the warning signs that showed up before both of those times are flashing again. Almost identical to what we saw at the peak of 1999. Almost identical to what we saw before 2008. If you own SCHD, this video is for you, because I'm going to show you what happened to people who saw it coming, and the one simple move that protected their wealth through both of those decades. Stay with me, this is the most important thing I will say on this channel this year. Let me give you the facts first, because this is not a scary story. It's history. The first time it happened in the 1970s. The S&P 500 gained only 17% over the entire 10 years. That sounds like something until you find out inflation was running so high that in real buying power terms, US investors lost nearly 50% of their wealth over that decade. 50% gone. Not from a crash, just from 10 years of going nowhere while prices rose. But here's what happened to the people who owned dividend-paying businesses during that same time. Consumer staples companies, healthcare companies, energy companies, utilities, the boring businesses that kept writing checks no matter what was happening in the economy, those investors held on. Those investors got paid, and those investors came out the other side with their wealth intact. Now the second time, the 2000s. The S&P 500 lost ground every single year on average. Negative 0.95% per year from 2000 to 2009. That is a full decade of less than zero. Dividends saved the people who had them. Research shows that during the entire lost decade of the 2000s, dividend income produced a positive 1.81% annual return, while the index itself was going backwards. Dividends contributed 100% of the total return during that decade. Without dividends, investors had nothing to show for 10 years of patience. And what else performed during the 2000s? Value stocks, high dividend yield stocks, international stocks, the boring stuff that nobody wanted while tech was flying. Now, here is the part that deserves your full attention. What did 1999 look like? A small group of technology companies dominated the entire market. Valuations were at extreme levels that had never been seen before. Everyone said it was different this time. What does the market look like right now? More than 30% of the S&P 500 sits in just 7 companies, all tied to technology and artificial intelligence. The S&P 500 trades at roughly 22 to 25 times earnings, well above its long-term average. Investors believe AI will grow forever. Many people are saying it is different this time. Here's what studies going back to 1964 show. When concentration reaches these extreme levels, the rest of the market has historically outperformed over the next 5 years, in the vast majority of cases studied. I'm not saying the market crashes tomorrow. I'm saying the math has been consistent for 60 years about what tends to follow extreme concentration. And SCHD investors, the very people this channel is built for, need to know this. Here's the bold truth. SCHD has always been one of the best built funds in the market. Its 10-year track record, requirement, and 4 financial screens mean you only own the elite of the elite. That is not changing. But SCHD only owns 100 US companies. That means your entire income stream depends on one country, one economy, one currency, one political system. In both past lost decades, that single country concentration is exactly what hurt people the most. Think about it this way. The investor who retired in January 2000 with $1 million in a 100% S&P 500 portfolio, withdrawing $40,000 per year, saw that million shrink to $455,000 by 2009. They did not make bad choices. They just had all their eggs in one basket. The US large cap basket. Right before that basket stopped working for a decade. A different investor who held global dividend stocks alongside their US holdings saw their same $1 million grow to nearly $1.9 million over the same 20-year period. Same starting amount, same withdrawals, completely different outcome, purely because of diversification. When a strategy is winning big, investors feel safe. They relax. They think the good times are permanent. That is exactly when portfolios become most vulnerable. The investors who came out of the 2000s with their wealth intact did not panic. They did not sell everything. They made one smart addition. They own dividend payers from outside the United States, Europe, Asia. Companies with the same discipline, the same quality standards, the same commitment to paying shareholders, just in different economies moving on different cycles. Right now, international dividend stocks are sitting at one of the widest valuation gaps to U.S. stocks in modern history. International dividend funds trade at roughly half the earnings multiple of U.S. stocks. Same quality, same discipline, just priced far more cheaply. When cycles turn, and they always turn, that gap closes fast. International stocks led the entire mid-2000s. They led from 1970 to 1989, and in 2025, the broad international index returned over 29%, while the S&P 500 returned around 16%. The turn may already be happening. Here is the practical answer. Simple, clear, and something you can act on today. SCHD is your foundation. Quality dividend payers, proven track record, low cost. Keep it. But adding SCHY, the Schwab International Dividend Equity ETF, gives you income from 100 of the best dividend payers outside the United States, using almost the exact same quality discipline as SCHD, for one of the lowest costs of any international dividend ETF on the market. Here's the key number. SCHD and SCHY have only a 0.67 correlation. They do not move together. When one struggles, the other often holds. That is what real protection looks like. If you're in your 30s or 40s and still building, a 70% SCHD and 30% SCHY split gives you U.S. dividend growth with a strong global income layer underneath it. If you're in your 50s or 60s and protecting what you have built, moving towards 60-40 or even 50-50 between SCHD and SCHY cuts your single country risk significantly while keeping income strong on both sides. Let me leave you with one thought. History does not repeat exactly, but it rhymes. And right now the market is playing a very familiar tune. Extreme concentration, elevated valuations, and the feeling that this time is different. SCHD is an excellent fund. I'm not telling you to leave it. I'm telling you that the investors who survived both lost decades did not just own quality U.S. dividend payers. They owned quality income from the whole world. The question is not whether another lost decade is coming. Nobody knows that. The question is whether your portfolio is ready if one does. Hit the like button if this opened your eyes and drop a comment below. Do you think SCHD alone is enough, or are you already adding international exposure? That debate belongs in the comments right now. I'll see you in the next video. Smart investing, profitable results. This video is for educational purposes only, and it is not financial advice. Past performance does not guarantee future results. Please consult a licensed financial professional before making investment decisions.